Hi and good evening, ladies and gentlemen. Welcome to this evening's webinar concerning the investment opportunities you can seize in China's technology sector via the iShares Hang Seng Tech ETF. This evening we have with us Mr. Tan Dejun, Senior Equity Analyst, Stocks and ETF Research at iFAST Singapore to share more with us. Mr. Tan is an equity analyst with the research team at iFAST. He provides analysis and research coverage on both stocks and ETFs listed on the Singapore, Hong Kong, and US markets. The global technology and semiconductor sectors are Dejun's areas of expertise. So with that, I'll just hand the time over to Mr. Tan Dejun.
Okay, thanks, John. So good evening, everyone. And welcome to another webinar hosted by FSM1. My name is Dejun. I'm a senior equity analyst here at FSM1. And for this webinar, I will be sharing more about China's technology sector, as well as the newly listed iShares Hang Seng Technology ETF. So today's webinar, it will be broken down into two parts. I will begin first by talking more about China's technology sector, give you a background on China's technology sector, some of the mega trends that are driving it, and then we will move on to talk about the ETF itself. And over here, I will cover various things such as the index construction methodology. We'll look at some of its holdings and as well as how it stacks up to its other peers. So now, if you have been investing in ETFs with FSM1, you would know that our recommended ETF for China's technology sector is actually the Invesco China Technology ETF, which is under the ticker CQQQ. So we have recently decided to switch this recommended ETF with the iShares Hang Seng Tech ETF. And over the next few slides, I will also be explaining to you what is the rationale behind this change. So with that out of the way, let's first talk about why we like China's technology sector. So China has come a long way since the 1980s. It has grown by leaps and bounds to become a global economic powerhouse that it is today. So today, China is actually the second largest economy in the world with an approximate 15% share of global GDP. So part of the reason for China's rapid growth is its widespread use of technology. So for the majority of Chinese citizens, technology today has become an indispensable part of their lives, one that's hard to live without. So the importance of technology can also be seen in China's stock market as well. So if you take a look at China's top 5 companies by market capitalization, we note that back in 2010, these largest companies, they mainly consist of companies that are from the financials and as well as the energy sectors. So over here, you see names like China Construction Bank, ICBC, Bank of China, which are all your major state-owned banks in China. And of course, you have PetroChina, which is one of the largest oil and gas companies in China itself. So you fast forward to 2020, and you can see that some of the most valuable companies that exist today, they are actually from the technology sector. So names include Alibaba, which is, of course, the owner of the Taobao shopping e-commerce platform, and Tencent, which is the creator of China's super app, WeChat. So China's tech sector has evolved greatly over the last decade, and we think that it will continue to do so over the next decade as well. Now, moving on, a key factor that has contributed to the rapid development of China's technology sector is the increasingly digitalized consumption habits of the Chinese population. So not only is consumption growing, consumption habits have also become increasingly digitalized, where people are more willing to pay for the convenience of on-demand services, from simple things such as food delivery to ride-hailing, and to more complicated services such as your banking and travel booking. So nowadays in China, almost everything can be done online thanks to advancements in technology. So this change in consumer habits actually gives rise to many opportunities for companies which are able to cater to them. So if you take e-commerce as an example, back in 2019, worldwide e-commerce sales hit a record high of 3.5 trillion US dollars, and the majority of which came from China, which is currently the largest e-commerce market that we have in the world. So over in China, key players include the names of the likes of Alibaba, JD.com, and Pinduoduo. So these 3 companies, they actually collectively control 80% of China's e-commerce market. And if you look over to the West, the US has the second largest e-commerce market in the world. So over there, it's no surprise that Amazon actually dominates the market with a 50% market share. And by some estimate, by 2023, global e-commerce is set to become a $6.5 trillion US dollar opportunity. And if you do the math, that works out to be a compound annual growth rate of 16.6%, which is quite substantial. So within China itself, e-commerce is also becoming the new model of retail, as the percentage of total retail sales conducted online has been increasingly steadily over the years. So if you look at this figure over here, you can see that today, roughly 20% of all retail purchases in China are done online, and that number is expected to increase over the next few years as technology plays a bigger role in China's economy. So the rising consumption around the world, it is a sign that consumer confidence still remains robust, especially in a country like China. So in China, there is actually no better indicator of consumer confidence than single-day sales, which is the largest shopping event of the year. So in 2019, single-day sales were actually twice the amount of Black Friday and Cyber Monday combined. So don't forget that this is also amidst the US-China trade war, as well as slowing economic growth in China. And besides e-commerce, the consumption of online services in China is also expected to grow quickly, and making up 24% of the total service consumption by 2023. So also, if you didn't know, China is not only home to the largest e-commerce market in the world, but it is also home to the largest food delivery market in the world as well. So in China, major players would be names like Meituan, as well as Ele.me, which is owned by Alibaba, and they are like the equivalent of Singapore's GrabFood and Foodpanda. Now, moving on. So there are a couple of reasons why the online consumer market in China is booming. First, with greater economic progression, China's population is becoming wealthier each year. And when I say that, I don't just mean for the people who live in the cities, but also for the rural citizens as well. So disposable income for both groups are at an all-time high, which leaves people with more money to spend, and that fuels consumption in China. Secondly, China has a huge number of internet users. So even though its internet penetration rate of 61% still pales in comparison with many developed markets where penetration rates can be as high as 95%, China is already home to 850 million internet users, which is greater than the total population of every other country in the world with the exception of India. And as China transits into a digital economy, penetration rates should continue to rise, and that will provide internet companies with plenty of opportunities for further growth. So over here, I have a graphic for you to sort of visualize how large China's internet space is. So as you can see from the various segments, even though China has a lower penetration rate, the number of users still far outweighs the US. So the only segment where China has a higher penetration rate compared to the US is actually in the mobile payment segment. So that is because China essentially skipped the entire credit card era, moving from cash all the way to mobile payments. So these days, mobile payments, they are a widely accepted mode of payment for most merchants in China, from everywhere like shopping malls to restaurants and even your street hawkers. So if you are planning a trip to China in the future, make sure that you familiarize yourself with how these apps work before you go. So earlier I mentioned that the number of internet users in China is expected to increase. So this increase, they are expected to come from two distinct sources: millennials and the rural population. So starting with millennials, there are roughly 350 million of them in China, which is about 25% of its total population. So millennials, many of them, they are brought up in an era where they are constantly exposed to technology and have grown to become avid internet users. So for some of you who have kids around this age, you might understand what I'm saying. Like when you bring them out to eat, their eyes are always glued to their mobile phone, and when they are at home, they are always looking at the computer or the TV. Whatever it is, their eyes are always glued to some screen. So the thing about millennials in China is that they actually contributed to 2/3 of the total online consumption growth last year. And we think that with higher spending power and a larger propensity to spend, millennials are progressively becoming China's biggest source of online consumers. Now, moving on to China's rural population. So China's rural population has approximately 560 million people now, and it is another huge untapped market for internet companies. So penetration rates in the rural regions remain well below urban regions of 70%. So penetration rates in the rural regions, they are about 40%. But this is quickly changing as the government is pushing big telco players to speed up the construction of internet infrastructure in the rural regions, so as to ensure that the rural population does not get left behind as China goes through a rapid urbanization. So the rising number of internet users from the rural regions will present Chinese technology companies with many new growth opportunities. So in fact, if you take a look at some of the recent earnings results by these internet companies, many of them have noted that growth in the recent few quarters, they have actually been contributed by, it is largely driven by the rural regions instead of the urban regions. And overall, we think that China's technology sector, even though it is still relatively young at this point in time, it still holds plenty of promise, and there are plenty of opportunities for these Chinese internet companies to take advantage of as many of these mega trends begin to unfold over the next few years. So now that you have a better understanding of China's technology sector, it's time to introduce our new recommended ETF, which is the iShares Hang Seng Tech ETF. So this ETF, it is listed on the Hong Kong Stock Exchange under the ticker 3067. So the objective of this ETF is to track a basket of 30 of the largest Chinese technology companies that are listed on the Hong Kong Exchange. So the companies that are included inside this index, they have to have high exposure to technology themes such as your internet, cloud computing, and e-commerce. So over the years, technology stocks have had a growing presence in Hong Kong's market. So this change, however, it is not reflected in its stock indices such as the Hang Seng Index or the HSCEI Index. So to this day, both indices, they still remain heavily weighted towards China's old economy sectors such as your financials and your energy, which I have shown you earlier. And this actually makes them a poor representation of China's modern economy. So with a focus on China's new economy stocks, we think that the Hang Seng Tech Index, as well as the ETFs that are tracking this index, it actually fills an existing market gap, and it allows investors to gain exposure to China's fast-growing technology sector. So now I would like to spend some time on the index construction methodology so you get a better understanding of how this index or this ETF actually chooses its constituents and what actually goes into its holdings. So first of all, the index, this entire process, there are multiple steps. And to be eligible for this index, companies will have to undergo a rigorous screening process. So in one of the preliminary stages, companies will have to meet minimum liquidity requirements set by the index provider. So this minimum liquidity threshold is actually determined using a velocity test, which in layman terms, it is simply a measure of turnover. So in addition to the minimum liquidity requirement, companies will also need to fulfill at least one of the following three criteria. So number one is to be in a technology-enabled business. Number two is to have an R&D expense to revenue ratio of greater than 5%. And lastly, it would be to have a year-on-year revenue growth rate of at least 10%. So finally, the remaining companies that pass through all the previous screens, they are then ranked by market cap, and the top 30 will form the index. So individual security weights, they are capped at a maximum of 8% each. And the index is reviewed and rebalanced on a quarterly basis using the exact same process. So another thing I forgot to mention is that a unique feature about this index is that unlike other market indices out there, this Hang Seng Tech Index has something called the IPO fast entry rule, which allows newly listed technology companies to be included in the index as early as on its 10th trading day, should the company's market cap rank among the top 10 of the existing index constituents after its first week of trading. So this means that the upcoming IPO of N Group, they are filing for an IPO on the Hong Kong Exchange, which is highly anticipated by investors, may be considered for fast track inclusion in this index. So, we think that with foreign listed companies, Chinese tech companies increasingly looking to list in Hong Kong, this index can actually allow investors to gain exposure to these newly listed companies using ETFs. So you don't actually have to go out and buy individual stocks and do stock picking if you're not comfortable with that. Now, moving on, I'd like to share a little bit about the historical performance of this index. So as we all know, technology stocks, they have been some of the biggest winners over the recent few years as the global economy becomes increasingly digitalized. So the COVID-19 pandemic has provided yet another shot in the arm as soaring demand for technology products and services have led to better than expected earnings for many of these technology companies. And given this index's focus on technology stocks, it is no surprise that this index has managed to beat the broader market over the past few years. So based on back-tested data, the Hang Seng Tech Index delivered cumulative returns of over 150% over the past 4 years, while the broader Hang Seng Index actually lagged behind significantly during the same period. So looking ahead, we believe that there is still plenty of potential for share prices of Chinese technology companies to appreciate. And this is actually supported by many of these mega trends that I have explained to you earlier, which is like the digitalization of consumption, the rising number of internet users. Now, let's move on to some of the reasons for why we have chosen this 3067 as our replacement for CQQQ. So sometime earlier this year, the CQQQ, the classification standard adopted by CQQQ, it underwent a significant change. So this, because of this change, the index classification system, it no longer recognizes e-commerce as a subsector of technology. So the result of this change is that some of your major e-commerce companies in China, like Alibaba, as well as some of its smaller peers like JD.com and Pinduoduo, they're actually excluded from CQQQ holdings. And we think that for an ETF that is focused on China technology to not have the largest Chinese technology company included as one of its holdings, we don't think that is really appropriate or good representation of China's technology sector. So this iShares Hang Seng Tech ETF, it alleviates this issue by taking a broader approach to index construction, which allows for the inclusion of other technology-related companies from various sectors, even though they may not be classified as technology companies using your traditional sector classification standards. So doing so actually makes this ETF a more wholesome representation of China's burgeoning tech sector. Now, moving on, another reason for why we like the iShares Hang Seng Tech ETF is that one of the main reasons is that it has a very low expense ratio. So it charges just 0.25% per annum. This is nearly 3 times cheaper than our old recommended ETF, which is CQQQ, which charges 0.7% per annum. So not only that, it is also cheaper than most of its peers, which are focused on China's technology sector, as you can see from the table over here. And as we all know, when it comes to ETFs and when it comes to expense ratios, high expense ratios, they are not desirable because if compounded over a long period, they tend to have a significant drag on returns, which is why when we select ETFs here at FSM1, we tend to put more weight on the expense ratio of an ETF so as to ensure that investors get the largest possible returns. So in addition to having a lower expense ratio, this iShares Hang Seng Tech ETF also stacks up well against its peers in terms of other measures like liquidity and assets under management. So at this point in time, you can see from the table here that the largest and most liquid ETF that we have is the one issued by CSOP, which is the third one from the top. So we think that this is because for popular indices like the Hang Seng Tech Index, usually the first issuer that comes up with an ETF, they tend to enjoy what we call a first mover advantage. And that's why it has an advantage in drawing funds into its ETF. But that being said, even though the 3067, it has a lower assets under management and average daily volume, we think that its low expense ratio more than makes up for it, and that investors should have no issues entering or exiting their positions easily. So taking all the above mentioned factors into account, we think that the iShares Hang Seng Tech ETF deserves a place on our ETF focus list. So that being said, investors who are currently holding on to the Invesco China Technology ETF shouldn't be worried. So we are not saying that CQQQ is a bad ETF and you need to sell it off immediately. No. Rather, we are saying that 3067 is a better and cheaper option for investors who are extremely cost conscious. So even though CQQQ has been bumped off our ETF focus list, it doesn't mean that is not a good ETF. And we want to reassure investors that CQQQ it still remains a viable option for your portfolio should you choose to continue keeping it. And it will also be available. It will also continue to be available on our platform as well as for RSP. However, investors who wish to RSP into our new recommended ETF, the iShares Hang Seng Tech ETF, should do so by placing a new order for the RSP. So that being said, I've come to the end of my presentation today. I hope that through this session, you are able to walk away with a better understanding of China's technology sector and why we chose the 3067 as our new recommended ETF. So thank you all for attending today's webinar, and please continue to stay safe, and I wish you all the best in your investing journey.